Welcome to the success stories of millionaires. Can you become a millionaire by following our protagonist's formula? Let's find out. What does it take to survive Nazi occupation as a Jewish teenager and emerge as one of the most successful financial speculators in history? How does someone transform personal experience with totalitarianism into a lifelong commitment to promoting open societies around the world? The story of George Soros represents an extraordinary journey of survival, intellectual discovery, and the application of philosophical ideas to financial markets and philanthropic endeavors. Born Georgi Schwartz in 1930 in Budapest, Hungary, Soros entered a world of rising anti-Semitism and political instability. His father Tivadar, a lawyer and prominent figure in Budapest's intellectual circles, had survived World War I as a prisoner of war in Russia and returned with deep skepticism about political systems and authority. These skeptical views would profoundly influence his son's worldview. When the Nazi occupation of Hungary began in 1944, Tivadar used his resources and ingenuity to protect his family, obtaining false identification papers and arranging for them to be hidden in various safe houses throughout Budapest. The experience of living under false identities during the Holocaust left an indelible mark on the young Soros. He later described this period as the most formative of his life, teaching him crucial lessons about risk, uncertainty, and the fragility of social structures. While other Jewish children were being transported to concentration camps, Soros and his family survived by understanding how systems work and where their vulnerabilities lay. These lessons in navigating complex, dangerous systems would later find expression in his approach to financial markets. After the war, Soros left communist Hungary in 1947 to study at the London School of Economics. Living in poverty and working as a railway porter and nightclub waiter, he immersed himself in philosophy, particularly the works of Karl Popper. Popper's concept of open society, a social structure that allows for peaceful transition of power and protects individual rights, became Soros's guiding philosophical principle. He wrote extensively about what he called reflexivity, the idea that people's perceptions influence reality in a self-reinforcing feedback loop, a concept that would later form the theoretical basis for his investment strategies. Soros's financial career began modestly in London at Merchant Bank, Singer and Friedlander. In 1956, he moved to New York City to work as an arbitrage trader, specializing in European securities. His unique background gave him insights into European markets that many American traders lacked. He recognized early that the emerging European common market would create new opportunities for cross-border investment, particularly in German banks and insurance companies that stood to benefit from economic integration. The creation of his first investment fund, First Eagle, in 1969, marked Soros's transition from analyst to portfolio manager. Working at Arnhold and S. Bleichroeder, he developed the Double Eagle Fund that would evolve into the famous Quantum Fund. His investment philosophy rejected the efficient market hypothesis that dominated academic finance, instead embracing his theory of reflexivity. He believed that financial markets were inherently unstable because participants' biased perceptions could change market fundamentals in predictable ways. The Quantum Fund, established in 1973 with partner Jim Rogers, became the vehicle for Soros's most famous trades. The fund's strategy was global and multi-asset, investing in stocks, bonds, currencies, and commodities anywhere in the world where Soros identified reflexive situations. His approach was fundamentally different from traditional money managers. He sought out market inefficiencies created by the gap between perception and reality, then placed concentrated bets when he believed the gap was about to close. Soros's most famous trade occurred on Black Wednesday in September 1992, when he forced the British government to devalue the pound sterling. Recognizing that Britain's economic fundamentals were incompatible with its exchange rate mechanism commitments, Soros built a massive short position against the pound through his quantum fund. When the British government exhausted its foreign currency reserves defending the unsustainable peg, they withdrew from the European exchange rate mechanism, and Soros earned an estimated $1 billion in profit. The pound trade demonstrated Soros's understanding of reflexivity in action. He recognized that market participants' belief in the British government's commitment to maintain the pound's value was creating an unsustainable situation. By betting against this prevailing wisdom, he helped precipitate the very outcome he predicted. The trade earned him the nickname, "the man who broke the Bank of England," and cemented his reputation as the world's most successful currency speculator. Throughout the 1990s, Soros continued to identify and exploit reflexive situations in global markets. His funds profited from the 1994 Mexican peso crisis and the 1997 Asian financial crisis, though these trades generated controversy about the role of speculators in emerging market economies. Soros argued that he was simply identifying existing economic imbalances rather than creating them, though critics accused him of exacerbating financial crises for personal profit. The creation of Soros Fund Management and his network of open society foundations represented the dual pillars of his life's work, mastering financial markets to fund his philanthropic vision. His philanthropic efforts began in 1979 with scholarships for black South Africans under apartheid, then expanded to support the democratization of communist Eastern Europe in the 1980s. He provided photocopiers to underground academic and cultural organizations in Hungary, then expanded throughout the Soviet bloc as communist regimes began to crumble. After the fall of the Berlin Wall, Soros's philanthropic efforts expanded dramatically. He established the Central European University in 1991 with a mission to promote critical thinking and support the transition from communism to open society. The university became a flagship institution embodying his commitment to Popperian principles, though it would later face political pressure from Hungary's increasingly authoritarian government. Soros's philanthropic philosophy reflected his theory of reflexivity applied to social change. He believed that societies, like markets, were reflexive systems where participants' beliefs could change social reality. His foundations worked to create what he called open societies by supporting independent media, promoting transparent governance, strengthening civil society organizations, and advancing public health and education initiatives. Rather than simply providing charity, his approach sought to change the underlying systems that perpetuated poverty and authoritarianism. The scale of Soros's philanthropic operations became unprecedented among individual donors. By the early 2000s, his open society network was spending approximately $400 million annually across more than 30 countries. His foundations played crucial roles in supporting democratic transitions in Eastern Europe, combating HIV/AIDS in Africa, promoting drug policy reform in the United States, and supporting Roma integration across Europe. This global operation represented the largest philanthropic effort by an individual in history. Soros's investment philosophy continued evolving as markets changed. He published The Alchemy of Finance in 1987, explaining his theory of reflexivity and providing case studies of his investment decisions. Unlike most successful investors who guard their strategies closely, Soros openly shared his methodology, believing that understanding reflexivity could help prevent financial crises. His subsequent books, including The Crisis of Global Capitalism and The New Paradigm for Financial Markets, further developed these ideas and warned about systemic risks in the global financial system. The dot-com bubble of the late 1990s provided another case study in reflexivity. Soros recognized that the prevailing narrative about the new economy was creating a self-reinforcing bubble in technology stocks. While his funds participated in the boom, he also understood its unsustainable nature and reduced exposure before the bubble burst in 2000. This ability to participate in market manias while maintaining awareness of their eventual unsustainability became a hallmark of his approach. The global financial crisis of 2008 validated many of Soros's long-standing warnings about financial market instability. He had repeatedly argued that the efficient market hypothesis was fundamentally flawed because it ignored the reflexive relationship between thinking and reality. When the crisis struck, he came out of semi-retirement to protect his funds and published urgent calls for regulatory reform. His testimony before Congress and continued writing emphasized the need for better understanding of reflexivity in financial regulation. Soros's later career saw him increasingly focused on political philosophy and philanthropy rather than day-to-day money management. He transferred control of his investment funds to external managers while remaining active in strategic decisions. His philanthropic work expanded to address new challenges, including the European migrant crisis, climate change, and what he viewed as rising authoritarianism in the United States and Europe. The political backlash against Soros, particularly from nationalist governments in Hungary and Poland, demonstrated the impact of his philanthropic work. These governments portrayed him as a shadowy manipulator seeking to undermine national sovereignty, allegations that Soros consistently denied. The attacks reflected both anti-Semitic tropes and genuine discomfort with his support for liberal democracy, immigration, and multiculturalism. Throughout his career, Soros maintained that his success came from recognizing his own fallibility. His theory of reflexivity included the understanding that all human knowledge is inherently imperfect and that participants in any system can never fully understand that system because their thinking affects the reality they're trying to comprehend. This humility about human understanding distinguished him from other financial titans who often displayed unshakable confidence in their own judgment. These are the 5 key principles behind Soros's success. First principle: understand reflexivity in complex systems. Soros's core insight was that participants' biased perceptions can change the fundamentals of the systems they're observing. In financial markets, this meant that bullish or bearish sentiment could become self-reinforcing, creating bubbles or crashes that traditional economic models couldn't predict. This understanding of feedback loops between perception and reality allowed him to identify market inefficiencies that others missed and became the theoretical foundation for his most successful trades. Second principle: embrace your fallibility. Unlike many successful investors who project absolute confidence, Soros built his philosophy around the recognition that all human knowledge is imperfect and subject to revision. He famously stated that it's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. This humility allowed him to quickly recognize and correct mistakes, a crucial advantage in volatile markets. Third principle: look for paradigm shifts. Soros excelled at identifying moments when old ways of thinking were becoming unsustainable and new paradigms were emerging. Whether recognizing the end of the Bretton Woods system in the 1970s or the unsustainability of fixed exchange rates in the 1990s, he understood that the biggest opportunities came during transitions between economic regimes. This ability to think in terms of system-level change rather than incremental movements gave him an edge over competitors focused on short-term fluctuations. Fourth principle: align profit with principle. While controversial for his currency speculation, Soros consistently sought to harmonize his financial activities with his philosophical beliefs. His philanthropic work represented an unprecedented effort to use wealth to promote open society principles globally. This integration of money and meaning created a cohesive life philosophy that extended beyond mere wealth accumulation to encompass social transformation. Fifth principle, concentrate bets when the odds favor you. Unlike modern portfolio theorists who advocate diversification, Soros believed in making concentrated investments when he identified significant reflexive situations. His largest positions often accounted for substantial portions of his fund's assets, reflecting his conviction that true opportunities were rare and should be exploited fully. This willingness to take substantial risk when he perceived asymmetric opportunities contributed significantly to his extraordinary returns. These principles formed the foundation of an approach to markets and philanthropy that made Soros one of the most influential figures in modern finance and global affairs. They demonstrate how philosophical insight, when combined with practical execution and moral purpose, can create extraordinary impact across multiple domains. To build a business that can scale with these principles, you need the right systems. Whether you sell digital or physical products, most entrepreneurs waste time juggling separate tools for their website, marketing, and sales. The solution is Go High Level, an all-in-one marketing and CRM system that lets you run your entire business, funnels, email, SMS campaigns, AI agents, and social media scheduling. You can even manage your client communication from a single portal on your phone. If you are ready to systemize your growth and build a business that scales, check out Go High Level. You can find my link for a trial in the description below. The story of George Soros offers profound lessons about the relationship between ideas and action, between financial success and social responsibility. From surviving the Holocaust to influencing global markets and supporting democratic movements, his journey demonstrates how theoretical insight, when combined with courage and conviction, can shape world events. If this exploration of financial philosophy and strategic philanthropy resonated with you, please watch our next personality on the success stories of millionaires. Thank you for watching. Goodbye for now.